All right, so I'm going to go over the recent meme stock runoff. Meme stocks have taken off again in August, just as quick as they shot up. They came falling back down. Names like GameStop, AMC Theaters, not the TV channel, or recently Bed Bath & Beyond are all meme stocks. These are by no means the only meme stocks, but are more prominent and have high interest around them. But what exactly is a meme stock? Meme stocks have no strict definition, so asking a dozen people will likely get you a dozen different answers, but here's a general guide to what they are. Communities are built around stocks on online media, commonly Reddit, maybe Twitter. The community needs to be organically built, or at least perceived as organically built. What I mean by that is if a company attempts to become a meme stock, it's unlikely to gain any momentum. The communities allow people to quickly share research that is both good and more likely bad quality, allowing people to quickly act as a group on the information. The second point they need is brand recognizable or nostalgic for the average person. This is a necessary ingredient for a large organic community to be built around the stock. If it is not recognizable, the stock will not have general appeal to create a large enough following. The company is downtrodden or not in their prime. People like an underdog story. That's why people always root for Brennan. So,
well played.
So when it comes to meme stocks, that have gained traction, they are all past their primes, which adds to why nostalgia is important, because people want to bring the company back to their rose-colored view. Many seeing the reason for the devaluation of the stock being due to unfair market practices or manipulation. Ultimately, if the company starts to pick up social momentum, it can translate into stock price momentum. The stock needs that mass appeal to retail investors to gain the traction in the short period of time. All right, now we're going to look at the rationales of why people invest. This list is by no means exhaustive, but some of the core reasons for investing in meme stocks is a trend. It's fun. People like trends. It's like the 90s with Beanie Babies. People invested it just because they saw others doing it, and they want to feel part of that community and part of something bigger than themselves. And this is a common thing. This is not the first time. It's not something unique to meme stocks, but it's the quality of it. And the second is people like to momentum trade. So if the price goes up, you buy. If the price goes down, you sell. That's what momentum trading is. You'll have hedge funds do it. You'll have amateur investors do it. It's not anything unique, but there's a lot of traders, because when you're seeing this volatility, that's what momentum traders do. They like to seek that out. Third is just purely gambling, hoping to win big. They're playing that lottery ticket, not caring about the odds or the risk, and they're likely using leverage or options to strike big. They're buying way out of the money options in many cases at 4 or 5 times the current price as their strike price. It can be quite a bit of leverage, to say the least. And the fourth, but perhaps the most intriguing and unique thing to meme stocks, is the activism nature of buying, or commonly anti-hedge fund or market manipulation protest. The common protest is against naked short selling, which is selling short when shares are not located or available, which is illegal. And there's tons of speculation online where you'll say some people they're lying about. I don't personally buy it, but that's the common argument for many of these people in the GameStop and AMC especially. And they believe purchasing these stocks will cause an uncoverable short squeeze, so it will just shoot up into infinity. I don't buy it personally, but I'm going to put that out there to the audience because that's what many argue. All right, the common phrase, I like the stock, which comes from Keith O, the man who started off the GameStop run in 2020, early 2021, as his rationale for buying the stock when initially asked on mainstream media. This is generally used as a generic phrase to why someone invests in the meme stock, as many people do not have an exact reason. They're gambling. They don't want to admit they're gambling, pretty much. Or they're having some sort of a combination of the above. All right. So the issues with meme stocks are many, to say the least, and it's not an understatement to say they are volatile. They are extremely volatile, even compared to volatile assets like cryptocurrencies. They're right up there, and in some cases, even more when you're looking at their market caps. The problem is the stocks are not trading on their underlying fundamentals when they're surging up. When you're seeing GameStop, this is before the split in January of 2021, hitting $800 on intraday trading. How can you justify that? Even if you're sturdy believer they're going to turn around. They're going to reintroduce used game market. They're going to take over the industry. That's a hard sell, to say the least, on a fundamental basis. So, double-digit changes are par for the course due to that. And now let's take a look at some of the recent volatility of Bed Bath & Beyond and AMC and the reasons why these prices are moving, because it's clearly not the fundamentals. First off, Bed Bath & Beyond, symbol BBBY on the NASDAQ, not BBY, which many people bought. That is Best Buy. Don't do that. Look at the stock. That is something which I saw common. Best Buy actually went up when this first started to happen. Make sure you're buying the right stock, even if it's a meme stock. All right, the stock starts in the month of August, roughly from $5 to an intraday peak of $30, 6 times in a few weeks. That doesn't sound like a normal company, even a penny stock. That's pretty absurd. This is largely due to the chair of GameStop, Ryan Cohen, having ownership in the company, and he's been taking to social media, pushing up the stock. An initial capitulation price on the 19th of August happened when rumors were reported of Ryan Cohen selling his shares, further capitulating on the confirmation of the rumors in this filing. In this case, it was sell the rumors and sell the news, which has now caused some to call for him to be investigated for market manipulation and fraud, including former SEC chair Harvey Pitt, expecting at least an investigation, but these things are hard to prove, so nothing may come out of it. Even if not legally culpable, it speaks to the dangers of following a trend set by someone with very obvious conflicts of interest. All right, moving to AMC, symbol AMC on the New York Stock Exchange. AMC needs to raise capital. It is no secret. They have $5.4 billion in long-term debt. They have operating leases on top of that. They're burning cash operationally. They've already sold shares during the initial meme stock run-up of 2021, and they are not authorized to issue any more shares, and shareholders refuse to allow that limit to be raised. Sorry, my cat is just sneaking around. He loves Sue. He is apparently a fan of meme stocks.
Pixel.
All right, so the shareholders refuse to allow the.
He's fully invested.
Exactly, he is a hardcore ape right here. All right, so the shareholders had refused for the board to allow any more authorized shares, which means they can't issue shares, they can't raise capital. So what they have done is they issued a preferred share dividend. This is not something normally done. Something like this would normally be done if, let's say, the company was doing a spin-off. They'll issue a share dividend to, let's say, run out a new company. They'll split off. This new senior share under the ticker APE, because all the retail investors refer to themselves lovingly as apes, was issued as dividend of all the AMC stockholders. This does not alter the current total fundamental value of the company, but it has effectively split the total market cap into the pre-existing AMC ticker and the new senior APE ticker. Just as a side note, the stock price charts have not been adjusted because this is a dividend, not a stock split. I've already seen that a few times online, people complaining, why are the stock, it shows it going down. It's because it's a dividend. This is what the people actually wanted to happen and not just a stock split. And that's why you're seeing that. All right, so the benefit to the investors of this happening is they can actually buy, this is a senior equity, so if there's a bankruptcy, the APE holders outrank the AMC holders, and they're likely to get either a liquidation. This doesn't happen lots. If a company does go into liquidation, normally equity is just wiped out. So why would the company do this then? They are appealing to retail investors. They're marketing that APE ticker, allowing them to effectively raise the authorized and issuable shares in the combined structures, which the shareholders previously voted against. The company board is now able to authorize the issue up to 5 billion of the APE shares, currently having authorized 1 billion and have issued 517 million for the dividend, leaving nearly 4.5 billion of senior APE shares left to capital raise to pay off the fundamental issue of debt. Simply put, the company wanted to appeal to the retail meme investors' desire not to dilute common stock, but they have done exactly that in a roundabout way. Overall, the companies that have become meme stocks are taking advantage of the heightened prices to cover the lack of operational performance.
Yeah, good job. I think it's super interesting that they call it, the ape. Like, it's like for right now, like there's like a big thing like with NFTs and whatnot, where it's like the Bored Apes. Like this is even kind of over my head, but it's pump. Like it's almost just a pump. It's very interesting to see a company like this do it.
It's all silly season, really.
It is.
I mean, like Brett said, you're not dealing with the underlying fundamentals of the business, and management or the boards are trying to take advantage of followings of retail investors. I mean, you're not dealing in what we would look at when we look at a business. Where's the cash flow? Is it growing? Is it a good business over the long term? So you're talking about basically gambling versus investing. And, like in these cases, just buyer beware. You're buying something that the fundamentals of these underlying businesses, AMC, Bed Bath & Beyond, all of these businesses are deteriorating over time. Many of them aren't profitable, haven't been profitable for years, or seeing declining revenues, have loads of debt. It's just like the opposite of the type of investment that we'd be looking for our clients. So, I mean, it is fun to talk about, and it's good theater. But, if you're looking at actually making money in the market long term, I mean, these are companies to just absolutely stay away from. You can look at AMC over the last month. It started the month at 14 something and then ran up to 25 and now is at 9. If you would have piled in when you saw all the meme investors piling in, you could have got it between 15 and 20. Now you're cut in half. Could be cut in half in your share price value. And right now, like, there's probably no justification for the valuation where it is today. So, I mean, you could be holding the bag for long.
Yeah, I should add that it's kind of more than $9, because if you add in the ape, which they all received, because it's just like a stock split, even though it doesn't behave like it, they're about $15. It's still down even after that, though. So the charts are a bit misleading. Yeah. So I'm treading about
Understood. This. Yeah. It's just for us. It's really this in some respects it in the investment arena generally, and trying to invest in good companies, these things are a sideshow and a circus that attract people's attention, but they really take away from the capital that should be raised and should be flowing into good, solid businesses that are, employing capital, creating value for shareholders and creating value in the economy. Many of these companies aren't doing that. So, I would hope that people, you can watch this. It's great theater. It's like a car wreck that you kind of can't look away from when you drive by, but avoiding it in your portfolio is a necessity for long-term growth. You're not going to be able to sleep at night.
That is an interesting point that you just made up, though, too. Like, I mean, the markets are like, over the long run, capital, like, that's the beauty of the markets, is capital over the long term will be allocated to, the best opportunities, and, efficiently allocated to, companies and great business models. These are not good business models. I've said it before, even on the podcast, where, like, for example, GameStop, I mean, someone like myself, if I'm going to go buy a video game on my PS5, I just do it right over the internet. It downloads right onto my PS5. I don't have to do anything going into a store or anything. So it's just, same thing with theaters. They're kind of a dying breed. I mean, I get it where, people are still going to be going to the theaters, but
although Brennan's never seen a movie, so he's the wrong one to ask about this.
The one movie which I saw Top Gun to,
because I dragged you to it.
Exactly. Yeah.
When we're at a conference, literally. Yeah. No. Anyway, but like the main point, I think we made it. We beat it to death on these companies. We can
enjoy
watch
it.
With an eye to theater, but and it's hilarious. But I mean, you want to build a portfolio of businesses that are growing, that have cash flow. Most of these do not have any of that, and I would keep them out of your portfolio.
And even as a long-term story, don't have a good story. Anyways, let's move on.